Good morning and Happy New Year. I'm Deborah Feldman, Managing Director of the Fairport Wealth Lee and Eddie team out of Chicago. It's hard to believe that 1 year ago we were dealing with market uncertainty over COVID, and here we are again, a newer COVID, but we're still dealing with market uncertainty. Let's hope 2022 will bring more of the same good market returns and a solution for COVID. We have a special welcome today to our newest teammates in Harrisburg, Pennsylvania. Welcome, FMA advisory clients. The goal of this town hall is to connect you directly with Chief Investment Officer John Silvas. He'll recap where we've been, describe where we are today, and share his thoughts on what lies ahead. We've asked for your questions in advance, and John and his team have prepared slides addressing them and other frequently asked questions. Based on your feedback, we've scheduled these webinars on a quarterly basis, and Emily Drake and I will take turns moderating. We know that your advisors are in continuous contact with the investment team, but there are some ways that you can be too. If you sign up for email delivery, you can expect to receive timely Fairport Perspectives updates. Or you can subscribe to the Fairport Flash podcast on Apple Podcasts, Stitcher, or Google Play. Or follow the hashtag Investing with Fairport on LinkedIn for weekly thoughts on the markets and economy. Now for a little housekeeping. Everyone will be muted for this webinar and your cameras are disabled. If you have questions that arise, you can type them into the questions section of your toolbar and we'll answer as many as we can, time permitting. So with that, I'm going to turn the mic and the camera over to John Silvas. There you go, John.
Thanks, Deb. Happy New Year to you and all our colleagues out there and everybody on the line. Appreciate it. And as I'm going to kick it off, and as you mentioned, Debbie, it feels like it's a little deja vu out there. So with the number of caseloads and all those things, and I tried to start this off with something a little funny, and I went out and I couldn't find. There was more cartoons about COVID than you would imagine, but I can only get it down to like 2 of my favorites, and this is kind of the way I've been feeling. You know, it feels like one, the one on the left there, it's kind of deja vu. It seems like we start over every couple months with a new variant, and then obviously we have I'm going to call that the guy from the CDC down there whacking away at the different variants of COVID. But in a lot of ways, it's a little same as where we were last year. But I will tell you. I think I'm hoping that we're closer to the end than we are to the middle of this, and I will speak for probably myself and most of our colleagues. I am about zoomed out as far as Zoom meetings go. So hopefully the next time we do one of these, we're getting closer to the end. So we'll see how it goes. But I thought we'd just start off with a quick review of 2021. What happened, as you mentioned, is a pretty good year in the markets, and we'll go over those returns as well. Looking forward to 2022, we'll talk about what our main what our main thoughts are. What's different this year than maybe last year, or what we see is different this year. Overall, we still think it's going to be a positive year in the markets, and we'll explain why we think that. So, to go from there, as I mentioned, 2021 was the 3rd positive year in a row, and to be honest, that's a good sign in the markets, but it's a pretty rare sign. You don't see 3 years in a row of positive returns that often. And I'll talk a little bit about that as we get into the call here. But a couple familiar themes, and you can look at the 3rd column from the right, which is the returns from 2021. As you can see, large cap was up 28.7%. Again, large caps outperformed small caps. That's for the last 5 years. We've seen that trend. Domestic equities, meaning the U.S. equities, outperformed international equities again. That's again, I think it's 5 out of the last 5 years. And then the bigger theme, stocks again outperform bonds, and that's again 4 out of the last 5 years. Global equities, which we look at quite often, and we use a benchmark called MSCI ACWI, or the All Country World Index. That was up about 19%. So in line with the overall global equities. There's one thing that we would point out, if you look at that, again, that 3rd column from the right, 2nd from the bottom, fixed income, and that's defined by the Bloomberg Ag Index, which is a bond index that's widely used, it was actually down 1.5%. So we saw a negative year in bonds. And we'll talk a little bit more about bonds and yields and where we think they're going to go in 2022, because I think that's going to be an important theme this year. But overall, it's a pretty very low volatility for the year. In fact, it was the fourth smallest drawdown we've seen since 1987 in the S&P. We were down, you can see my cursor there, down about 5% at the lowest point, and that was probably in the near the second half of the year, actually near the end of the year. It's pretty funny because it's very similar to what we saw in 2020 or 2017. We only saw a 3% drawdown in the equity markets defined by the S&P. Both of them were the first year presidential administrations. 2017 was obviously President Trump, and then this year, 2021, or I should say last year, 2021, was the first year President Biden. Not really drawing any conclusions there. I just thought that was interesting. But overall, we do think we're probably due for a more substantial correction, and we'll talk about that in a second. But Ned Davis does a lot of historical research, and on average, and I've used these terms before, we see 10% correction about every 330 days. So it's a little more than a year in the markets. We've gone about 450 days. Now you can go much longer than that, but history would tell you that we're probably approaching that point where we're overdue for market correction. And those things happen in bull markets, so nothing to be that big of a concern in an uptrend. So, as I mentioned, the fourth quarter of 2021, we saw 10% return. It's a pretty strong finish to the year. That's 7 quarters in a row we saw positive returns. And so history would point out that, as you can see here, there's about 6 other occurrences out there where you saw streaks of 7 quarters or more. And, a body in motion tends to stay in motion. So as you see there with the red box there, 2 quarters down the road, which would put us to about midpoint this year, you tend to see positive returns. In fact, the last 6 times it happened, they were all positive. Not a lot of data points there, so it's not something I would use in isolation, but I think in the bigger picture, it's important to point out. We're all still concerned about caseloads and the pandemic. I would have thought at this point we would see smaller rises in caseloads as we got more and more people vaccinated. This new Omicron variant kind of put that whole process to bed, and we're seeing a big spike here. But I do think you start to see a peak there, and I think the markets are starting to take these things in stride. It's less about the number of cases and more about the severity of cases, and the severity of cases definitely seems to be waning some, especially for those people that are vaccinated and or have their boosters. So just kind of important, London's already seen a peak in their numbers, and they're coming down, and they've come down pretty quickly. And I think I saw it was yesterday or Monday that New York was either at a peak or close to peaking, and there was a lot of signs that those numbers were coming down. And as you can see, these numbers are daily, and they get skewed a little bit around the holidays, but it seems like we're either close to the peak or or just past it. So fingers crossed on that. But I do believe people are getting back to normal to a certain extent. A couple of headlines here just to kind of put some numbers to it. Spider-Man, if you're a Marvel's fanatic like myself, saw the 3rd best cinematic opening in history. Not the 3rd best during the pandemic, the 3rd best in history. Saw 253 million. Seats were sold out for most of the weekends. That was right after Thanksgiving, where we were, in the middle of this new variant. And then I also put down there for my friends here in the state of Ohio. Ohio State had, on average, about 96,000 people at a home game this year. I was at one of those home games. There was over 100,000 people. For our newest members in Harrisburg, I was also in State College at a Penn State game as well. Had 100,000 people there too. So I think people are getting back to normal. I know the theaters are opening. I saw somewhere the Eagles. I didn't know the Eagles were even touring, but they're coming to Cleveland, and it sounds like they're going to sell out the arena here. So I do think we're getting back to normal, whatever that new normal is. So I'm going to pause there. That's kind of our 2021 review. We'll jump into the economy here, but before we do, Deb, is there any questions out there?
I know people are concerned about inflation. And I know I've heard you mention in the past that it won't be an issue in the second half of the year as much as the first half.
Yeah, so I think it's probably going to be a bigger issue in the first half than the second half.
Yeah,
And
why is that, John?
yeah, so I think there's a couple things, and again, I would say that's one of our lower convictions calls. But I think as you look out, and we'll talk about it. In fact, today the CPI, which is the Consumer Price Index, which is kind of generally accepted as the inflation number, it was up 7%, which is I think the highest since 1982, if I read it right.
Yeah.
And maybe actually 1992, but either way, it's a very high number, 7%. But I think we're getting close to that peaking. I think the biggest thing is there is wages, which I think wages are going to continue to go up. Commodity prices seem to be pulling back a little bit in here. A lot of the supply constraints that we saw in the second half of last year, especially with the shipping containers and the West Coast and all those things, seem to be easing up as well. So I think if the Fed's doing their job right, and it seems like we're going to start to raise interest rates sometime around March, you should see those numbers wane. I don't know if we get back to that 2% data that we saw before, but I think we're going to get, the long-term average is about 3.5% if you go back 50 years. I think we'll get closer to that as we get into the second half of the year. So, stay tuned on that one. There's a lot of moving parts, but that's kind of where we see things progressing as we get into the middle of the year and then into the end of the year.
Okay, thank you.
Sure. Any other questions, Deb, out there from anybody? Or
not in this area, no.
Okay, great. So we'll move on and we'll talk about the economy. So for those that get our perspectives, I know Debbie mentioned that earlier. We do an email or a blast at the beginning of the year, kind of going over our top themes for the year. Some are economic, some are market driven. I put a few of them on here, and I'll just kind of go over them quickly. We think the current economic expansion continues into 2022. That's not a hard one. We think we'll see above trend growth again, somewhere probably around 4%. We think the employment picture continues to improve. Wouldn't be surprised if we see us slide down towards 3% in the unemployment rate. This is the one that's been spoken about the most. The Federal Reserve is expected, and we think it's very highly likely will raise interest rates multiple times in 2022. Currently, the estimate is 4 times. It started off the year at 3, it moved to 4. That's going to be a fluid number. We're going to see a lot, but I think for sure they're going to start raising rates. I think they'll do it more than multiple times this year. And then as Debbie and I just talked about, we think inflation is definitely going to be at least the first half of the year issue. Could bleed into the second half, but we think we'll see a little bit of it. We'll see a peak and then it start to wane in the second half. So, as far as the economy goes, it definitely has bounced back from the delta and supply constraints we saw in the third and fourth quarter. This is Atlanta Fed's GDP Now estimate, and they're estimating a 6.8% fourth quarter GDP growth, and that's a year-over-year number on an annualized basis. Most people on the street, Evercore ISI's example, are looking at 6%. I think JP Morgan's a little bit below that at 5.8 or 5.9. So we think we're going to have a good close to the year. Some of that's going to be affected by some of the Omicron and people sheltering and not visiting because of people being positive. So could see a little bit of that, maybe wane, maybe a little to the downside of that 6%. But again, fourth quarter looks pretty good, and I think that's going to be a good barometer going into the first quarter, which we obviously just started. So again, this is kind of a flashback to a certain point. We talked about the town halls. We've been doing these since April of 2020, and we kind of laid out things that we were looking at then that we thought were important as far as barometers, either the economy or the markets. And one of them was Evercore ISI, which is a leading macro forecasting group out of New York City. They look at company surveys. They've been doing this for, I think, over 30 years now, and it's been a really good real-time indicator where the economy is going. And they continue to look pretty strong. The most recent number is 56. Anytime it's above 55, it usually means above trend growth. Anything above 40 means, 45 means positive growth. And if you get below 45, as we did back in 2020, then you start to say, okay, well, the economy may be contracting. So I think overall things look pretty good as far as the economy goes. Company surveys continue to look pretty good. You know, we're always at the mercy of the next variant or next outbreak, so those things can be a little bit shaky at times, but we're pretty firm on where we think the economy is going. Job market continues to reaccelerate. Unemployment claims are down towards historic lows, and it's not really a jobs issue. It's really more of getting people to return to the workforce or the job force out there. So I don't know how much further we can push this number lower, but again, it's a pretty good indication of a healthy economy. And as I mentioned earlier, unemployment rate's down to 3.9%. We think it gets below that. We have a red line there. That's the previous low in February of 2020, right before the pandemic. It was at 3.5. We think we can get at least to that, but most likely we'll get below that going into the new year. And I wouldn't be surprised if we get there by the middle of the year. And then the flip side of people getting jobs would be obviously the layoff announcements. And this is a 13-week moving average, which doesn't really take into effect where we've seen the last few weeks. But layoff announcements are pretty much non-existent. I mean, the last week there was hardly any. So it just shows you how good this labor market is, and probably one of the better labor markets we've seen in a long time. And again, I think it's a matter of getting people to return to the workforce, and some of that's because of COVID concerns. It could be healthcare concerns, childcare. There's a lot of reasons why, but there's a certain percentage out there that are just quitting their jobs, and it's a phenomenon we're not used to. Most of the time, we're worried about people getting jobs. Now the number is more of how many people quit their jobs over the last month, which is ironic, but something we're again keeping an eye on. But so overall, I think for me, I always call this my deserted island chart. If I only got one chart a month or one data piece a month, consumer net worth to me would be the one, because it tends to lead the economy by 2 quarters, and it's a combination of the market, it's a combination of housing, consumer sentiment. So to me, it's a great number to look at, and it's obviously predicting further gains in the economy. So as we've mentioned before, if the economy is growing, it tends to be good for corporate earnings. If corporate earnings are growing, that tends to be good for the markets. And I think that story will play out over the next couple of years. As I mentioned before, we think the economic expansion continues. They tend to go somewhere between 5 and 10 years, on average 7. We're a little bit more than halfway through the second one. So I think we have further upside here going forward. Doesn't mean we won't see corrections in the markets, but and again, the housing market, it looks good. I stole this line from one of the leading housing analysts out there. Is the housing issue is not based on needs, it's based on need, not greed. So a lot of it has to do with demographics. Millennials entering the housing market, they're getting married, they're looking to buy houses. There's not enough houses to go around. Prices have been moving up. It's one of the reasons we actually like anything housing related. The home builders, the Home Depots of the world, the home improvement companies like Sherwin-Williams, Home Depot, those type of things, and then anybody in the building product space or even the furnishing space. So we think that's a theme that's going to play out for a while, and we have several looks at it, but something we think is a big theme based on demographics. So it should last for several years going forward. I'm going to stop there. We'll jump into the markets, but I want to pause and see if we have any questions.
Okay, we do. In the event of future conflict, even war in the Ukraine and other regions, how will this affect investment stability?
So that's an interesting question. We get it from time to time, especially as the geopolitical issues pop up. You mentioned Ukraine. I would throw in China and Taiwan. There's a little bit of rumblings about the Taiwan, China moving a little bit more towards authoritarian policies. I just read a couple of days ago there's an issue in Kazakhstan with some political uprising there. So I think these things pop up all the time. You know, you can go back to the Bay of Pigs invasion in the 60s and Gulf War, the conflict in Bosnia. You can go down the list. They tend to have a lot of headline risk, and I think that can, on a short-term basis, affect markets. Longer term, they don't really tend to have that big of a influence. Obviously, if you put boots on the ground and the U.S. is bogged down in the military conflict, that's a different story. But I think from a geopolitical policy process, it doesn't have a lot of effect. I mean, Ukraine's a great example. I think Russia first moved into the Ukraine or put the conflict started in 2014, so it's been over 7 years, and you know, markets have done pretty well in that time frame. So you know, it's something you keep an eye on. It's something we look at. I think can have short-term effects. I don't think it's going to have a long-term effect on markets, at least as it plays out today. You know, those things could obviously change. So.
Okay, here's another one about market stability, and it has to do with COVID. With COVID, workforce instability, et cetera, how does this affect investment stability? There seems to be a disconnect between current stock market and world conditions, or is it just that businesses and products just continue despite the world chaos?
So I think when there's a will, there's a way, right? So people find a way. But that being said, you know, we've had this question several times over the last, call it 2 years, where why is the market doing so well when the economy's not, or things look really bad today, but the market's moving up? And you know, that's always been the case. The market tends to be forward-looking, and it's discounting the future. So, you know, I know coming out of the bottom in March 23rd, when the market bottomed, the economy at that point in March 23rd of 2020 looked like things were in disarray. I mean, most things were shut down. Unemployment was over 10%. You know, we had several people, they were passing stimulus programs to avoid evictions and apartments and stuff, but the market was going up, and it was always a disconnect. And that's not uncommon when you have either market or economic bottoms or peaks, recessions or peaks. And I think you're seeing that a little bit today. I mean, I saw, I'm going to get the airline wrong, it was either United or Delta. They had 3,000 people call off from COVID, and they're canceling flights. You're going to see that, I think, throughout the year, at least the first half of the year. And if we have more of these outbreaks, you'll continue to see that. But the markets tend to look forward. And I think if you're looking at 2022, at least for the first half or midpoint of the year, it looks like the economy is doing pretty well. So, you know, the headline today could be different than what the market's seeing 6 months down the road, and that's not uncommon. It seems counterintuitive, and I understand why people sometimes think that, but that's just kind of the way the market works.
Okay, thank you. That's it for now.
All right. So, like we had economic themes, we have a few market themes here, and I think first and foremost, we think the equity markets will return another positive year this year, driven mostly by earnings growth, not by multiple expansion, which was what we thought last year and really what played out in 2021. We think that'll be a continuation this year. We do expect a correction, consolidation at the least, but most likely a correction, call it 10% or more. Those things happen, like I said, in the bull market. I think that's normal in the process. We do see more volatility in midterm election years, which is this year, 2022. So that kind of plays into that theme as well. We do think there's a possibility of a rotation out of sector leadership. We've seen growth do really well in large cap space. I think as we move into this year and have a different outcome from risk appetites and those things as the pandemic continues, we might start to see perhaps this is the year value overtakes growth. It's gotten off to a pretty good start here in the first 7 to 10 trading days of the year. International equities, this may be their year. but we don't think so, probably not. And I can tell you why, but I don't think we're going to see it again this year. But a lot can change there as we go forward. And then I think, much like I use the term transitory from Chairman Powell as the kind of the investment word of the year for 2021, I think this year it's going to be Metaverse. You're going to hear a lot about it. I wish I could tell you exactly what it is, but I probably would get it wrong. Facebook changed their name to Facebook, the Metaverse platform, Meta Platforms, I believe. If anybody bought their son or spouse a set of AR goggles, augmented reality goggles, I'd love to know, because I'm just kind of curious how that whole process works. But we think that's going to be a big theme as we go forward. So again, if history is a guide, we should see further gains in 2022. As I started off talking about, it was the third year in a row, and that tends to be a good sign, and it's pretty rare. We've only seen that happen 3 times in history, where we had at least 3 years in a row of gains of called 18% or more. As you can see on the left there, 2019 was at 31%, 2020 was a little over 18, and then we finished 2021 at that number is only through I think it's through November, but we finished around 29%, a little below that. So fourth year tend to be strong. Again, there's only 3 data points, but if you start building the mosaic around some of these, I think you can see a pattern here. And on average, it's about 27%. Now, we think we see probably muted returns this year, probably somewhere in that 8 to 10% range, with a lot more volatility than we've seen over the previous year. But we do think we'll see a positive year, and I think, again, as I said earlier, when a body's in motion, it tends to stay in motion. And we think with the backdrop of a positive economy and earnings growth going forward, we should see another positive year in equity markets. But it's going to be a bumpy ride, is my guess. So valuations have come down from their peak, but they're still elevated. We finished the year in 2020 at 22 times. We finished the year in 2021 at about 21 times. I thought we'd get closer to 20. I still think we'll see a push down towards 20, which means, again, that we'll have to see earnings pick up the slack on that, and we think they will. But I do think there's a lot of stimulus in the pipeline. If you look at all the stimulus that's passed this year, that usually takes about 12 months to get in. So most of that will be hitting the economy and our earnings next year. And I do think it's going to be another negative or at least muted year for bonds and bond returns. So on a relative basis from stock to bonds, I mean that's another reason why we think, although valuations are high, we think we'll see a positive year in 2022. Earnings again remain strong heading into the fourth quarter. JP Morgan and a couple other banks report, I think, tomorrow, kick off earnings season. We expect to see, again, positive earnings growth. Probably not as high as we saw in the third quarter, most likely a peak in the third quarter as far as a percentage of growth, but we should see growth, somewhere between 8 and 10%, or maybe slightly better than that going into the fourth quarter, which again, I think at the end of the day is what has the highest correlation direction of earnings, or direction of the market is earnings. One of the things that we are keeping a close eye on, and again, this is one of the reasons why we think maybe international equities have a fighting chance this year, is the dollar tends to peak when the Fed begins changing course or raising rates. That dotted red line down the middle is when the Fed, on average, will start raising rates. If you go back to the last 8 cycles, they did that. Dollar tends to peak right around there or slightly before that. You could argue the dollar might be peaking now, and most likely we're going to see a Fed increase in March, so it's not too far off from the average. But again, I think, over the last 8 cycles, the dollar tended to weaken after we saw that. So again, we're keeping a close eye on that. So I mentioned a little bit about bonds and our thoughts on rates. 2021 was one of the worst years for bond returns. As you can see, it was down a little less than 2%. If you look to the all the way to the right there, we've only had 4 times since 1976 where we saw negative returns on bonds. I won't. It's tough to, and I'll show a chart here. It's tough to see 2 years in a row. It's pretty rare, but I do think we're going to see some lot of headwinds on bonds, especially on the total returns. We've already seen rates go from 150 at the end of the previous year, 2 weeks ago, a week and a half ago, and they're already up, I think, 25 basis points from there. So I think most are looking for rates to be somewhere around 2%. Some are even high as 2.5%. And I think if we see that, it's going to be another tough year, and we could possibly see another negative return for bonds out there. Just to kind of put it in perspective, we've only seen it happen since the 50s twice, and it actually happened in the late 50s, 55 and 56, and then 58 and 59, where we saw negative returns. So it's not, doesn't happen too often, but we're at the beginning of what we think will be a Fed tightening cycle with multiple interest rate increases and the economy heating up behind that. So the fact that we could see rates go from what is probably way too low at 150 at the end of 2021 to somewhere north of 2% in 2022 doesn't seem like a big jump to us. And if that would happen, that would put you about flat on bonds going forward. And just to kind of give you that look here, here's the 10-year interest. The 10-year interest rate, and it got up to 176. Kind of broke that trend line of 170. That kind of gives the next move to probably closer to 2% from a technical standpoint, which again will put pressure on the total return of bonds going forward. So it's not a prediction necessarily that we'll see negative returns. I think we're just going to see very muted returns going forward. Now, if we see rates backtrack here and get down below 150, then that story changes. It's our best guess that that's not going to happen. But overall, relative to speaking about the fixed income market, spreads remain pretty firm, as you can see in that bottom chart here with the blue arrow. Spreads between double B and triple B, which tends to be a good indicator of the health of the overall fixed income market, still look very close or down to historic lows. So credit market looks pretty good, and if the credit markets and the credit spreads start to widen, that usually tends to be a negative sign for equity markets, and we just haven't seen that. So I'm going to pause there, Deb. We'll jump into portfolios here in a second, but if there's any other questions out there.
Well, you mentioned Metaverse, which I know a lot of people aren't familiar with that even. I wasn't, so I looked it up. And it appears that Facebook, Epic Games, Microsoft, Roblox are throwing a lot of money in this direction. They want to capitalize on this technology. What might we be looking at to participate in this market? Is there anything you find interesting?
Yeah, so on our large cap portfolio, we already own Facebook, and I think Facebook is kind of has thrown down the gauntlet on this one. So I think I would say they're one of the leading firms out there right now. They own something called Oculus, which are those headsets you see people wear. There's a couple of commercials out there about them already. So I think they're already trying to stake claim to that, a large piece of that. But some of it's more the picks and shovels of things. The Microsofts and the Amazons and even Google, tend to be really big players in the cloud. And there's a lot of talk about if this is to expand and become a big thing. And again, I think we're still learning what it is. You're going to need a lot of cloud-based computing. So I think, that's kind of more picks and shovels out there. But I think, it's something we're looking at. Same with chips, chip makers. If you're going to do a lot of cloud space, you need servers. And if you need servers, you need chips in those servers. We own a couple different aspects of the semiconductor business. So it's an interesting space. I don't think anybody really has a firm handle on what it is or how it's going to look down the road. I think Mark Zuckerberg, who founded Facebook and runs it, I think has a vision himself. If that's the overall vision, we'll see. But I know Apple, for example, is coming out with their own set of headset goggles, I think next year or later this year. So they're entering the space as well. We own a big position in Apple as well. So I think we have some aspects of it, but I think that's going to be a changing theme going down the road. And as I mentioned, I think the word metaverse will be used a lot. If you ask 7 out of the 10 people, they probably don't know exactly what it is, but I think we're all going to be learning as we go.
Well, I know I read that Fortnite for gamers is
Right.
the closest we're coming to it right now.
Yeah, your best bet is probably to find someone under the age of 20 and ask them. That's probably your best bet.
Yeah. You mentioned earlier that you like home building companies. Real estate's been strong for, I mean, I looked at your chart and you saw that aqua color up at the top several times every other year or so. Would this be something you'd consider overweighting possibly in the portfolios? I know we have a 2.5 or 2.75% allocation.
So I'm gonna move to the next slide because there we go. So you know, this is our breakdown of our sectors on at the end of the year. So 12/31 of 21. So a little over a week ago, and it's about middle of the page here. You can see real estate. We're about even. We're about 2.7. The benchmark or the S&P is about 2.6, 2.7 as well, I should say. So we've been about a market weight, but that we were actually underweight that, so we've actually moved to a market weight. So I guess I'll kick it off by just kind of telling you where the changes were this year. We started the year underweight energy. We're now slightly, and I say slightly above energy. We were underweight real estate. We're about even on real estate. We've actually moved to underweight in technology. That's more of a function of just making some portfolio changes. We'll probably move back to a neutral weight, if not better there. And we're overweight financials. So we've done a little bit of changing. Still overweight cyclicals for the most part, industrials, discretionary, and materials, but have definitely seen some changes. Specifically, your question about real estate, you know, I tend to think it's had a pretty good run. I think it'll be positive most likely in the current year. I don't know if we can market leadership going forward, but that's something, as you pointed out, you know, it tends to be one of the better performers out there. So I wouldn't count it out, but you know, we're kind of market neutral at this point. I think valuations are a little rich in that area, but again, you can see further gains before you see those multiples correct.
Okay, you mentioned foreign stock earlier, and one of the questions that came in is if it's underperforming the domestic markets and other market sectors, why hold it at all right now in the near term?
Yeah, that's a great question. We've gotten it more recently over the last few years. You know, I think at the end of the day, you want to have a pretty diversified portfolio. You know, we tend to invest globally, and you know, even in the S&P 500, I want to say 30 to 40% of the earnings come from overseas. So you're always going to have some global or / international exposure, and you know, they tend to go in cycles. So you're going to have areas where emerging markets, you know, last year emerging markets did really well. This year they didn't do as well, and I think you're going to see that cyclicality in the equity markets. Hasn't worked out recently, but we don't think that process is dead. So I think you always want to have some exposure. You know, as far as not having any in the short term or maybe this year versus next year, you know, that gets into kind of market timing to a certain extent, and I think that's always hard to do. Where we're going to be in technology, but not in international this year, and next year we'll be in international, not technology or whatever it might be. So it's just philosophically not how we look at it. And you know, we benchmark against a global benchmark, which obviously has 40%, as I mentioned earlier, roughly in international equities. So you know, we're committed to that space longer term.
Okay. Thank you. That's all.
All right, Deb. So I'm gonna go through a couple more here. I already started on the one which is the sector breakdown. We did talk about as one of the themes, we think there might be some, you know, beginning of a rotation, or we might see a rotation this year. Growth has outperformed value. That's like the green spaces here. So if you go back to, let's say 2008, we've seen a pretty long outperformance in growth. It kind of peaked back in the end of August, and we've had a little bit of bouncing and filling here. This is the chart from Ned Davis, and their view is you have to have a 20% correction from the trend before you change it, meaning value would be outperforming growth from a secular standpoint. Haven't seen that yet. I don't know if we'll get to it this year, but I do think that that trend in growth outperforming values has gone on pretty long. It looks like there's a sort of a churning going on there, and we would not be surprised, especially with higher rates helping financials and a couple other spaces. And higher rates tend to be a little bit more of a detriment to technology, which is a big cyclical component, and/or a growth component. You could see some consolidation there and potentially see a rotation. So that's something we're keeping a pretty close eye on. Another area that we touched on briefly when I was talking about the sectors is energies. The energy sector, it's kind of the unloved, but it's been breaking out recently. Oil is up to $81. It's had a pretty good run here over the last year or two. A lot of reasons why it's unloved, as I mentioned. The people that invest through either impact or ESG tend to exclude energy a lot because of the fossil fuel aspect of it, which I totally understand. Every day you open the newspaper up, there's more talk about EVs or electronic vehicles, and Tesla's going to rule the world, and Rivian came out, and Ford's going to have a bunch of EVs out, and so is GM and all those things, which obviously won't need oil or gas in them. So there's a lot of reasons to be unloved, but again, oil prices are going up, which tends to be the biggest driver for the energy sector. And two, as we come out of this global recovery, demand is kind of outstripping supply, at least initially. I don't think that'll last long term, but has been a benefit for the energy sector. So that's a sector we're neutral at today. I don't know if we'll ever move to an overweight on it, but we have moved to a neutral weighting, and I think you'll see further upside as we get into this year as well. And we already kind of talked a little bit about this, but international equities they look attractive on valuations, and this is a chart on MSCI ACWI All World ex US, so everything outside of the United States on a global basis relative to the US, which is determined by the S&P 500 here, and it's trading about 32% below its normal ratio between the US and the international. So you could argue that the valuations look attractive for international equities, and as I mentioned earlier, as the Fed starts to raise rates, you tend to see the dollar weaken, which again is a good tailwind for international equities. So we could see that outperformance. I'm slightly skeptical, but again, I think it's a possibility. And we're keeping a close eye on. I think the emerging markets from that standpoint is probably better positioned than some of the more developed markets like Europe or Japan, but something we're keeping a close eye on. And the last thing is just kind of things we're watching as we go forward. A lot of these I already mentioned, but I'm going to kind of go through them again quickly. Before I do that, is there any other questions out there, Deb?
This is a technology question. It has to do with 3D printing and housing. This technology may be for building lower cost housing. Not quite a solution yet, but are there investments opportunities related to this technology, or will investments towards the builders or industries that utilize the technology have another tool in their tool bag? So I think what he's asking is, are we going to invest directly in companies that create the technology, let's say 3D printing in use with architectural drawings and housing, or is that going to be kind of swallowed up and it'll be at the builders and where it's just a tool in their tool bag? How would we participate?
Yeah, I'm going to give you an answer. I don't know if it'll totally hit the question, but so I think from we tend to diversify through asset classes, large, mid, and small caps. I think some of those small caps, you're going to have exposure to companies like that, the 3D printers and those type of things. They tend to be smaller, more innovative type companies. So you do get some exposure there. From a home building aspect and 3D printing and housing and those things, we do own a couple. We own a housing manufacturer, a home builder. So I'd imagine you can get some exposure there. I think bigger picture is, you're looking at, new innovations out there. How do you get access to some of these innovations? And we've talked a little bit about that with clients on a one-on-one basis. And if this person wants to give us a call, we can go through the process. We tend to look at ETFs that might have some exposure to those spaces. They tend to be smaller companies, so it's not something we tend to buy directly for clients, but it's something we can talk about. And 3D printing is one of them. Robotics, the AR stuff that I mentioned, or artificial intelligence or augmented reality. There's a lot of those things out there. We tend to look at it from a broad bucket standpoint, and if any of those clients want to reach out to us, we can have a discussion on that as well.
Okay. What do you consider a good hedge against inflation?
Equities. Equities tend to be the best hedge against inflation.
Okay.
Again.
I think they were looking for a Bitcoin or a gold answer.
Oh, well, yeah, well, I can't speak to Bitcoin. I don't, we don't really have a policy in place, or I should say opinion in place on Bitcoin. I think, people use gold as a hedge in inflation. I'm not convinced that's a great hedge, but that's something that's been used historically over the centuries, I guess you could say. But if you look at what's the best hedge to inflation, equities really, from an asset class standpoint, tend to be the best. Real estate, I would imagine you can kind of throw in there. You can buy tips if you wanted. We have some exposure to tips in our portfolios, but I think bigger picture, we've used some hedged equity positions. They do have a little bit more risk to them relative to bonds, but they tend to have a less than just a pure equity exposure to the S&P or something, and that's helped as well. So there's a couple possibilities. Again, I would probably suggest that person reach out to their advisor, and we can set up a call and we can go through that. Probably get a little more detail what they're looking for, and probably help them a little more on a granular basis.
Okay, thank you. That's it for now.
Okay, great. So last, kind of what we're watching. I wish I was walking on the beach right now, but anyway, there's a lot of things I think out there, and again, I think that the economy is going to look pretty good in 2022. I don't know if the markets probably won't grow as quickly as or look as good as the economy. I think we'll see positive returns. So this is a list that came out from Evercore ISI, just things they're looking at to lift growth in 2022. I won't cover them all, but like the first one, I think, as I mentioned earlier, there's a lot of monetary stimulus that came into the system last year that's still coming in. It takes about 12 months to lag before it hits the economy. So we're really just now seeing all the benefits from the trillions of dollars that was spent in 2020, 2021. Supply chains at number 2 that I think are going to be less of an issue, less of a headline that you see. It's already starting to come down. I already talked about 4, which is the consumer net worth. And I guess if I have to throw another one out there, I think it's just number 6, which is sustained expansion. I think as people get jobs, they get wage increases, they spend more money. That helps to grow the economy. The economy grows, earnings grow because people are spending more money, and it just becomes a cycle. And I think we're in the early stage of that cycle. Obviously, all the different variants out there and the shutdowns and those things can be a headwind to that, but hopefully it will subside as we get into the year. Stock markets, I think this is important as we hear more and more about the Fed tightening, the tapering, which is first, and then the tightening is after that, getting kind of moved up and more rate increases than the beginning of the year. It went from 3 to 4. I think it's important to point out that the stock market tends to peak when the Fed is done raising rates, not when they begin to raise rates. And this has been documented pretty well. So historically, the first rate hike is not that big of a deal. If you could look at some of the highlighted positions there, I would say we're probably about 3 months out. So we're in that negative 3 months category, give or take. There's a little bit of a digestion period in the 3 months after a Fed hike, but if you look at 6 months or a year, it tends to be positive. 6 months after the first Fed hike, on average, market returns are about 8%. So again, I don't think it's something to be feared. I think when the Fed's done raising rates, that's when you start worried about where the market's going, because it's usually because they tighten too much and the economy's slowing down, and that's when you start to worry. But we'll see. Inflation was another question asked. I think it's a key as we head into the midterm elections. So we have a sitting president, and all presidents, like it or not, or even if they're not up for re-election, it's about the economy, as James Carville once said. So if you look at this column, all voters, about 87%, they said 9 out of 10 are at least concerned about inflation. I think the point that the current administration is worried about is the independents. That tends to be where most of the battles fought on elections, and about, again, almost 9 out of 10 people are concerned there as well. So I think that's going to be a big issue. We're going to hear a lot about it. I know as we get into the election, it'll probably be one of the bigger themes. So it's way too early for predictions, but if you look at history as a guide, sitting administrations, meaning the Democrats in this case, who also control House and Senate, tend to see losses, at least in the House, pretty consistently. Right now, they're predicting anywhere from 20 to 40 seats. That number is going to change quite a bit as we get into the middle of the year. But I do think it's going to be tough sledding for the current leadership in the House, and we'll see where that goes. But a lot can happen. I think the Senate's going to be a little closer, but it really doesn't matter who wins, in my opinion. It's once we get past that, because as you can see on this chart, as I mentioned earlier, we thought we'd see more volatility in the year. That's something we're keeping a close eye on. During midterm election years, which is that red line, you tend to see a market, peak around April. Again, this is an average over the last since 1950, so it doesn't always happen exactly on the line. But you see kind of a peak in the first half or first quarter, and then you see some sideways movement or even a consolidation, which is why we think, again, we could see some correction here this year. And then as you get closer to election, call Labor Day or so, markets tend to move back up again, because it's really not a concern about who wins. It's just a matter that what the policy changes will be as you get into the post-election. And then the year after the election, returns are positive after the midterms. So if you go back to 1950, and midterm elections happen every 4 years, the average return on equities is about 15% from the 12 months after the election. So called from November to November. Also bleeds into the third year of the presidential cycle, which we'll talk about next year as we get closer to that. And it's always been positive. So, my view of the world is I think we're going to see a choppy year. It's going to be positive, probably much more muted returns than we've seen over the last 3 years. But I think, as we get closer to the midterm elections and we get some of this behind us, and hopefully a better handle on the pandemic, and we move more into an endemic, we should see better returns in the second half of the year, probably more backloaded this year than normal. But my thought would be stay invested as we would always preach over the time frame. I think, again, fixed income is going to see some tough sledding here. I think if rates stay above 2% on the 10-year, we're going to have really tough returns, at least this year. So that's something we're keeping a close eye on. We're only 7 trading days into the year, so I don't want to get too far ahead of ourselves. But I'm going to close it there, Deb, unless there's any more questions out there.
No, John, that's the end.
So as I always try to throw out there, I'd like to thank everybody that helped us. I know Debbie and I are on this call, but Annika and the marketing group do a lot of hard work for us in getting everything compliance approved, and same with the investment team. So I appreciate all the hard work as well as all our colleagues out there. And welcome to our newest group in Harrisburg as well.
Thanks, John. If we were unable to get to your question today, the investment team or your advisor will reach out to you directly if you let them know. And lastly, for John and I and the entire Cleveland, Chicago, and Harrisburg teams, we want to thank you all for joining us today. It is really our privilege to inspire you and your family, and we feel sincere gratitude and thank you for your trust and loyalty. Stay safe and well, and until next time, thank you. Bye, everybody.
Bye.